Jay, what's your view to the market?
Die Stummschaltung ist aufgehoben.
Good morning, ladies and gentlemen. Good morning, Jens. Thank you for the introduction. Been a while since we had the joy of working together, so let's get right into it. First thing I always do is check former positions, and like I said, we haven't seen each other for a while. I think the last trade was our short Kiwi, and as we can see, you need to be able to fine tune it a little bit because we had a bottom base underneath the liquidity here, and then we took off on a risk on environment. Nevertheless, we had the direction correct. Anywho, headlines overnight. Risk picture was mixed. China is on holiday. US and Canada agreed a trade deal to replace NAFTA. It's now called the US-Mexico-Canada Agreement. Obviously, that is very bullish for the Canadian dollar. So dollar CAD saw some weakness, i.e. Canadian dollar saw a 4-month high. And we also saw some yen weakness on the back of numbers. Asian equities did trade mixed. We had lackluster performance on Wall Street on Friday. Like I said, China is on holiday. We did have Chinese economic data though, and the PMIs on the manufacturing side slowed down. So on the back of that, we saw some weakness in the Aussie dollar, some weakness in the main index in Australia on the equity side, and obviously some copper weakness. So I'm already prepping my daily chart, as you can see here, where I'm looking to long the US dollar versus the Canadian dollar. Yen, as I said, we saw a weak Tankan survey and also a slowdown in manufacturing PMIs. Please be aware that we are starting to see a slowing down in different national manufacturing PMIs around the globe. On the radar, also, we have the Italian budget, which will probably not get approval by the EU at 2.4% deficit. And what would be a neck breaker is if rates were to rise. Italy is heavily indebted, too big to fail. And then we obviously have Brexit and the turmoil on the political front that Prime Minister May is facing. Very complicated and messy in terms of the headlines. If you are a swing trader, if you are working full time and you're putting in your overnight orders, maybe have a think about staying out of the pound for a while. If you are a day trader intraday and you're able to sit with a live news squawk in front of the screens, highly advise you to take advantage of the volatility. Very reactive, the pound to headline feed. All right, strength versus weakness. As alluded to, we saw some overnight strength in the Canadian dollar and some weakness in the Japanese yen. Risk events for this week. I put a reminder in there for myself that we go through it live together because it's just quicker. Let's refresh and have a quick look. We can see Chinese PMIs weaker on the services side, better, but the manufacturing side weaker across the board. German retail sales weaker. That was of interest to me. Not on the year-on-year side, though. That came in as expected. Tomorrow we have pound. Is that tomorrow? No, that's later on today. No, that was already. Manufacturing PMI came better in the UK, but then some weak lending data. This afternoon, ISM manufacturing in the US, slightly weaker versus last time. Tomorrow we have the RBA rate statement. I put together a slide for us on that one, but expected obviously to keep rates unchanged. In New Zealand tomorrow, we have the milk price index. Keep an eye on that. That's always of importance to the New Zealand economy. Fed speakers and central bank speakers throughout the week. We'll start tomorrow, excuse my French, with Powell, and he's talking about the outlook for employment and inflation at the National Association for Business Economics meeting in Boston. Audience questions expected. That is relevant, so we could see some late night volatility there. Building approvals in Australia, we keep an eye on that because the RBA keeps an eye on the housing market. Then we have services PMI expected to come in slightly weaker on Wednesday on the pound side. We have ADP sometimes, or in the past, used to be a little bit of an input factor for the non-farms, expected to come in at 187. And then we have non-manufacturing in the States, also expected to come a tiny little bit weaker than last time. Recall, every time we look at PMIs, 50 is the line in the sand, 45 to 50. Then we have Jay Powell again in front of the mic, this time at the Atlantic Festival, but no audience questions expected, and topic also not given, topic of his speech. Trade balance, obviously of importance on Thursday over in Australia. Australia is a suburb of China, so we expect a little bit of weakness on the back of the worse than expected Chinese manufacturing PMIs, and we do see that weakness this morning in the Aussie dollar. And we also see some Swiss franc weakness, by the way. We have Quarles speaking, and again, we need to check in front of community banks, audience questions expected. Okay, if a central bank wants to test new policies or new ideas, they usually send someone in front of a mic and speak out on the idea, and so it's always of relevance to us to check. The other thing is, if a hawk were to speak dovish or a dove were to speak hawkish, that also can have an impact on the currency. Over in Canada, we have IV PMI 62.3. That's good. It's better than last time in terms of its expectation. And we have retail sales in Australia on Friday, also expected to come in a little bit better. And in terms of the commitment of traders report, we've been patient and we are waiting for a long on the Aussie dollar, but I can unfortunately only repeat myself as long as we have the trade war between US and China, which may last for a very, very long time. And as long as we have no new information that were to have the market price in an earlier rate hike than 2020 in Australia, that potential long out of the positioning is not materializing. That's unfortunately a fact. It's always the macro picture that you need to understand, because the macro picture is the driver for everything. And then we have employment numbers out of Canada and the US, and average hourly earnings expected to take down a tiny little bit here. Don't be alarmed by the 185K. It's all in line. It's around a 200K average, and we're still there. And then the unemployment rate to tick lower. Insane numbers in terms of unemployment in the US. And then we have Bostic speaking. So we have a few potential catalysts for this week, but we have four major ones. On the pound side, we did have September manufacturing PMI to decline. That was the expectation. I'm scrolling up, and we came in at 53.8, so better than expected. August had a slowdown to a 25-month low. Now, the problem is, did the pound react to that or not? We take a quick look at the future, and not really. We're still in a range, so the pound versus the US dollar is not really. We came off a low yesterday, Friday, and we're on our way to test the liquidity above us. That's futures trading, sorry guys, but it's just cleaner. September services PMI is seen slipping to 54 from 54.3. That I will be in front of my screens there, because that can be a good trading opportunity. The number one industry in the UK is the financial services industry, and that may suffer given a Brexit or a hard Brexit. So I'm interested to see how weak this number may potentially come in. Trade wars are having a negative effect on the export-orientated manufacturers, obviously. And in the August services PMI, we already saw that optimism among firms slipped to a 5-month low. The firms are getting upset and worried, and they're holding back on future capital investments because they do not know what may or may not materialize after a hard or soft or mediocre Brexit. It's a mess, guys. Problems remain the increasing inflation, while at the same time seeing soft pay growth, and that exerts pressure on households' real income. That's not good for domestic demand. The second event obviously is non-farm. First week every Friday of a new month. It's expected to come in 184 versus previous 201, but that current pace that I said earlier around 200 is still intact. Initial jobless claims is a leading economic indicator for unemployment insurers continues to hit fresh all-time lows on a weekly basis. So don't get worried about the 214 here. The employment situation is unreal in America. Openings continue to post all-time highs, are now near 7 million. That means we now have more job openings than there are folks unemployed given the U3 measure. If you don't know what the U3 unemployment measure is, Google will tell you. It's an economic measure of who is counted and not counted. And this development of job openings versus not enough qualified personnel is obviously expected to increase wage pressures. And so average hourly earnings are expected to rise above 3% towards this year, end of this year, early 2019. So the market is already aware of that. That doesn't mean that if we have a very large hourly earnings number on Friday above expectations, it doesn't mean that we don't see a reaction, but do not be upset if the reaction is counter to what your intuition tells you, because the market is already starting to price that number in. Currently, we have a 78.8% probability for another one rate hike, 25 basis points, at the 19 December 2018 Fed meeting. Okay, if this number goes up, the dollar continues to rise. If the number goes down, the dollar is expected to come off a little bit. Third event of the week is the Canadian dollar. Unemployment numbers, the forecast currently for a gain of 24.7. We had a very large drop in August, and then prior to that, we had a very large gain in July, and that was due to the sector of educational services. But there's a seasonal pattern to that in July to September, so that's expected to come off again. A gain is expected in Canada. So the jobless rate is expected to edge lower to 5.9 from 6. At least the economists of RBC are telling us that. The consensus is for it to remain at 6%, but we wanted to give you a different view. Average hourly earnings are seen falling to 2.6 year on year for permanent employees after seeing a peak of 3.9 in May. So again, if average hourly earnings were to go through the roof, the thinking of the market is that the RBC will have to hike to combat potential inflation or an overheating of the economy, and then the currency were to follow. But the Bank of Canada's preferred measure is, in terms of wage pressures, is the wage common measure, and that remains stable around 2.4 on a year-to-year basis. So short reaction if this number comes massively above expectation, but we already have an expectation for the Bank of Canada to hike during the October meeting. Okay, and then last but not least, we have the central bank meeting and rate decision over in Australia. That's tonight. RBA is expected to leave the rates unchanged at 1.5%. They established that rate in August of 16, and it's expected to remain that way until 2020. In terms of wording, so one of our traders is Hendrik, is the head of central bank research, and he does a fantastic job in telling us exactly which word has changed, is being left out, or was added to any given central bank rate decision statement. And it is really that important. Any change in a single word means something, and a central bank in the Western world is very keen on having a clear communication with the market. So the wording that we are expecting is for the governor to state further progress in reducing unemployment and having inflation return to target is expected, although this progress is likely to be gradual. And if that progress is likely to be gradual, the rate hiking pace of the RBA is also expected to be gradual, i.e. they're not even starting until 2020. If this is a hawkish hold, we expect something to change in terms of their wording or in terms of their expectation when it comes to GDP growth or when it comes to inflation expectations. So speaking of GDP growth, economic growth has been rising at above trend rate this year at 3.4. Sad to see this trade war, because we would have made and already would be making a lot of money longing the Australian dollar because it is going okay there. Unfortunately, the trade war is ruining that. Inflation with 2.1 is within the target band, as you can see. All right, and then the jobless rate at 5.3, it is a 6-year low. Obviously, it's not 53% of Australians are unemployed. That's 5.3, excuse me. Issues are, what is the RBA focusing on? Household debt, wage growth or lack of, and housing prices in relation to tighter lending conditions. Tier 1 and Tier 2 banks in Australia have adjusted upwards their variable rate when it comes to mortgage refinancings and mortgages, and that took pressure off the RBA to raise rates. So very positive development there for the RBA. Positioning real quick, as you can see, dollar positioning calculated thanks to Michael, one of our traders. He's doing that one for us. Commitment of traders, I was going to say, as always, Aussie and Kiwi on their way to a long signal. Unfortunately, not there yet. Volatility came off across the 4 measures that we keep an eye on. We see euro came off a little bit, pound came off a little bit, yen came off a little bit, and the VIX increased a tiny little bit. I saw a fantastic interview this weekend with Stan Druckenmiller, the best money manager on earth, the absolute undefeated #1 track record ever seen on this planet. And even he was short US equities starting in July and got a bloody nose. I myself also expected equities to come off, and there's just no way. We do not have an alternative currently to US equities, unfortunately. And emerging markets are expected to get hurt a little bit more the further the dollar rises in terms of strength, and dollar yields keep pushing higher, which they do. Bullish for the Monday London session was long Aussie dollar. Again, did the Aussie dollar react at all? Let's have a quick look. Not really. We're range bound, so not there yet. Dollar Swissy long. Yep, I do recall that the Swissy is seeing some weakness. Yes, as I'm looking over, we see Swissy. So that worked out nice. Bearish on Monday, short euro pound. I am not necessarily looking to short euros, to tell you the truth. We did see a reaction this morning off of the bottom edge right here, and then POC, and now we tested settlement of Friday, and in my opinion, we're going to test higher. So keep an eye on that. Option flows, we saw bullish on Monday, Aussie, pound, Canadian, Swissy, and gold. Canadian for sure. And bearish euro and yen. Well, that didn't materialize. Yen did materialize. I saw a lot of sellers, aggressive market sellers this morning. Buyers, and sell limit orders kept pushing lower. But now the buyers are starting to catch on a tiny little bit. So where does it leave us? What are we doing this week? What are we doing? Thank you, Jay, for 800 minutes of fundamental talk. What is my friggin' trade? It's not that easy this week, seriously. It is painful because we have Brexit. It is painful because we have the Italian budget. It is painful because I expect dollar continue to go stronger. So the potential high risk trade for this week is to short New Zealand versus Canadian dollar. Why? New Zealand, I just don't see anything good coming out of the econ numbers this week. Fortunately, we don't really have that much news coming out of New Zealand for this week. We only have the business confidence, which last time came in quite low. Have a look. Yeah, so we're on a decreasing path here. That's bearish. Then we have the GDT price index. That's been bearish for the past few months. And then we have ANZ commodity prices. That's also been bearish with negative Chinese PMIs. Why would I be bullish on commodities currently? So New Zealand short, I'm okay with that. Canadian dollar long. Obviously, this new NAFTA, USMCA, my ass, in place. Trump is expected to sign it into law and then pass it on to Congress for it to get ratified by the end of November. So let's consider that done. Then I'm currently bullish on oil. There's just so much demand in the oil market. It is insane. The very harsh sanctions on Iran are taking effect next month. So that is why we are seeing a rising oil market, even though we are seeing also a strengthening dollar. That is a contrary to what we would usually expect, but that just means that we are in a demand environment. And the market is pricing in a rate hike or starting to increase the probability for a RBC rate hike in October. So having said all of that, what is the risk to the trade? Obviously, if New Zealand all of a sudden sees better economic numbers, or, and that is important for my traders, listen up, less worsening numbers. That can already be enough for the currency to see some inflows and or risk on sentiment. And then on Canada, obviously the opposite. If we have negative numbers and or a breakdown in oil prices, which, as I said, I don't really perceive right now. Okay, and then maybe we're going to get a retracement. Maybe we're going to get a retracement to the POC. Obviously, there's some liquidity here above that role reversal that we're seeing right here. But you got to make up your mind. So maybe we'll see a retracement to the POC, and then off we go down to 84.30. But I checked the monthly levels. There's an 83.50. So for those of you who want to stay longer or increase in case the trade performs as expected, you want to increase your winner. So have that 83.50 on your radar. And that's it. 11:23. I wish you a happy week, a successful week. Watch your psychology. Don't ruin your winners. Cut your losses early. Let your winners run. And then you're well on your path to making a lot of money in this business. Thank you for showing up as always. And thank you, Jens, for the opportunity to work for you guys. Cheers. Cheers.
Thank you, Jay. We have 5 days a week, 5 different traders. So if you like Jay, next Monday is the next chance to see and watch him. If you like other trading styles, like more scalping or more chart analysis, then just watch us the other days. 5 days a week, 5 different traders and 5 different trading styles. This is Atme Markets and this is real-time daily trading ideas. And if you like to see and watch that again, a couple of hours later, it will be available on our YouTube channel.